I also like that. When you guys look more like.
Okay, folks. There are quite a few quizzes that haven't been picked up yet. So again, I'm going to leave them out for a few more days before I bring them in. So if you haven't picked up your quiz, please do so. Your case is due a week from Wednesday, right? So if you haven't read the case, time to do it. If you have read the case, it's actually going to help you because as we go through these classes, there'll be moments you say, okay, that connects, okay? So let's continue with our discussion. We're talking about the Rio Disney theme park. And I worked through the numbers. Remember, your job is to be the decision maker. You just have to decide whether to invest in this project or not. I worked through the numbers. In my first iteration, I thought like an accountant. I measured the earnings on the project. I measured what's invested on the project from an accounting perspective, book value. And I came up with an accounting return on capital. Not rocket science, dividing the after-tax operating income by the invested capital. And my return on capital for this project was 4.18%. So this is the slide I left you on. What should I compare the 4.18% to make a judgment on whether to take the project? Now, when we talk about discount rates, we very loosely use the word opportunity cost, which kind of means something, but it means nothing if you don't clarify opportunity cost in what sense. So McHenry, help me out. When I say the opportunity cost, what is it that I need to add on to make sure I get it right? So what is an opportunity? Finish that off. Best investment you can make given the risk of what you're comparing it to, right? Because if you don't add that, you're saying, well, I can invest my money. So let's go through one by one and see what the right choices are. Why is the risk-free rate not the opportunity cost for this investment? Derek? Because there's additional risk. I'm comparing apples to oranges. I'm going to cross that out, okay? The cost of equity is not the opportunity cost, and this is a little technicality. Think of how I measured the return on capital. I took operating income before interest expenses, and divided by invested capital, which comes from both debt and equity. It's a measure of return on total capital invested, so I can't compare to the cost of equity because it's not apples and apples. I've got to compare it to the cost of capital, which effectively brings me down to two choices. Should I compare to the cost of capital for the entire company, or should I compare to the cost of capital for theme parks? Anoki, what do you think? Which cost of capital should I compare this to? You got a 50-50 shot. I'll help you out if you get the wrong choice. Company's cost of capital or cost of capital theme parks? Go back to what we earlier, McHenry said, the opportunity cost is what you will invest in a project of equivalent risk, right? If you take that to the next step, the cost of capital, you should be comparing it to should be the cost of capital for the theme parks because it's a theme park investment. So if I were to pick one number here, it would be 6.61% because that is the cost of capital for this particular investment. When I first started teaching corporate finance, we used to do capital budgeting first. That's what I was taught to do. And then we went to risk and return and discount rates. And it never made sense to me. Because how can you talk about the net present value of a project or the return on project without bringing in what the hurdle rate for that project should be? So if I had to pick one number, it would be 6.61%, but there's one qualifier I'm going to add. Where were Disney's existing theme parks in 2013? Orlando, Anaheim, Tokyo, Paris. Hong Kong had just opened up, but almost entirely in developed markets, right? Where's this theme park going to be? In Rio. Is there some additional risk that Disney's going to be exposed to? Absolutely. In fact, there are two additional risks that Disney's exposed to when it invests in the Rio Disney theme park. Patrick, give me one of the two risks it's exposed to. But there's a country risk. Brazil is clearly a riskier environment to invest in. What's the other that you expose yourself to anytime you invest outside your own country? There's foreign exchange risk, right? Currency risk. I'm going to argue we have to treat those two risks differently, and here's why. The exchange rate risk that comes from investing outside, I'm not worried about as Disney. If you remember the top 17 investors in Disney, they're all institutional investors. Can BlackRock take care of itself when it comes to? Absolutely. They invest across the world. The dollar strengthens. Some companies are helped, some are hurt. Exchange rate risk is diversifiable to the marginal investors, at least in Disney. Now, if you're a smaller privately held company or a closely held publicly traded company, you could argue that this might not be the case. You have to bring in exchange rate risk. But exchange rate risk to a publicly traded company where the investors are globally diversified, as Disney is going to go away. Everybody agree with that rationale? So when I'm investing in, if this had been Disney Frankfurt, not Disney Rio, I'd have used the 6.61% cost of capital and said, you know what, it's a foreign market, I have exchange rate risk, but I'm not worried. The country risk is another beast altogether. That is additional risk that will affect my earnings and cash flows that is not diversifiable, and I have to bring that risk into my discount rate. You see where I'm going next, right? I have to add something to my 6.61% to capture the additional risk. But by now, we've already talked. We had a quiz on country risk. By now, we know how to deal with country risk. So here's what I'm going to do. I'm going to go back and recalculate the cost of capital for the theme park business with a Brazil country risk embedded in that cost of capital. Sounds like I'm going to do something sophisticated, but here's all I did. The risk-free rate still stays 2.75%. I'm still doing things in US dollars. I haven't switched to reais. The beta is still the beta for theme parks. That doesn't change. The only number that I changed was instead of using my US equity risk premium or Disney's equity risk premium, I used the equity risk premium that I'd come for Brazil as a country by adding that additional country risk premium to my mature market premium. 8.5%, much higher equity risk premium, much higher cost of equity, and leading to, so everything else in the equation stays the same, but I bring in country risk into my cost of equity. Already you can see if you're a multinational and you work entirely in US dollars, your hurdle rate for the same project in different parts of the world is going to be different because of differences in country risk. And that intuitively makes sense. I should be charging more for a project in a risky country than I do in a safer country. And this becomes the vehicle I use to bring it in. Any questions on that 8.46% cost of capital? So from this point on, you have your hurdle rate. Remember, you're the decision maker. You need to make 8.46%. What is this project making? 4.18%, right? Looks like a no-brainer. This is a bad project. Reject the project. But before you do that, there's one thing I need to add about that 4.18%. Do you remember how many years I projected out earnings to get to 4.18%? I stopped in year 10. Why did I stop in year 10? You know that half of all projects in the US have lifetimes of 10 years. What happens at the end of year 10? Do projects just fall apart? Is there a good reason you think? What do you think? 10-year life. You see it in valuations, you see it in project analysis. That's magical, right? Why not 9? Why not 12? It seems a little arbitrary, doesn't it? Nice round number. Maybe this is just me being cynical, but I think 10 is what fits comfortably going landscape on a page. If you're printing off a table, you think that is so absurd. You know how infuriating it is to have one extra column popping up on an extra page? And this was before the days you could shrink to fit. There's no good reason why I stopped after year 10. You got to stop somewhere, I know. But the reason I bring that up is if you go back and look at the pattern of returns over time, notice that the returns rise as I go from year 1 to 10. If I pull this out to 15 years, my return on capital is going to go up, right? 20 years, even more. I think that's going to be true for any investment. But in this case, I think there's a reason that 10 years is really hurting my project. How old is Disneyland as a theme park? Let's see how many of you know your Disney history. When was Disneyland opened? 1956. Okay? It's been around 68 years. It makes more money for Disney now than it did 10 years ago, and definitely more money than it did in the first 10 years. Disney World is almost 53 years old. Makes more money for Disney now than it did 10, 20, 30 years ago. I remember the first few years of Euro Disney, people talked about how much of a disaster it was because it was losing money. Now Euro Disney is a cash cow. You see where I'm going with these, right? Big infrastructure investments in the first 10 years, you're catching them in the worst 10 years of their history, just before they become cash cows. So while 10 years might seem like it's a fair life to use for every investment, it's extremely unfair to your really long-term investments to cut them off after 10 years and say, hey, the project didn't pay off. So one of the problems with accounting returns that you can't easily get over is you have to stop somewhere. And if that somewhere is too short for a given project, you can end up penalizing a project, not because it's a bad project, but because you cut it off at the prime of its life. We'll come back and talk about something we can do about it, but not much we can do. In an accounting return perspective, you got to stop this somewhere. Now, I'm going to go on a little tangent here with return on capital because this has become a metric that gets used in consulting firms and banking all the time. What I computed with the theme park was a return on capital for a new project. But if you think about what goes to return on capital, it's after-tax operating income on the project divided by the book value of capital invested in the project. I can compute an accounting return on capital for an entire company. Here's what I'll do. I'll take the after-tax operating income for the companies. If you take Disney, $6.92 billion. That comes right off the income statement. And I'll go to the balance sheet and I'll take book value of equity plus book value of debt minus cash. It's called invested capital. I'm essentially taking the entire company and treating it as if it's a gigantic project. What I get as a return on capital is 12.61%. You're saying, what does that tell me? To the extent that I trust accountants, because remember, you're completely trusting accountants to get that aggregate number. Disney as a company earns 12.61% on its existing projects. Remember, we talked about a financial balance sheet, things that a company's already done are existing investments, assets in place. Here's a question I'm asking is before I get ambitious about the future, are the company's existing investments good investments, neutral investments, or bad investments? And to make that judgment, I compare the return on capital to the cost of capital, the collective cost of capital of the company. And at least in a very crude sense, Disney looks like it's earning about 4.8% more than its cost of capital. Why? Whenever you get a number, you'll get this number for your company. Trust me, I will force you there, and you will get a number for your company. I wanted to stop and ask the question, why? What is it about Disney that allows it to earn more than the cost of capital? In Econ 101, when you have perfect competition, no company earns more than its cost of capital, because the minute you do that, competition comes in and wipes out. So the very fact that you're earning more than the cost of capital means that you're not just not in perfect competition, but there are some barriers to entry, some competitive advantages that the company has. With Disney, that should be easy to identify, right? What is it that allows Disney to earn more than its cost of capital? And in fact, it's more than it's a mouse with big ears. I mean, let's face it, a huge chunk of value comes from those legacy. And now you've added to that, you got the Avengers, you got, essentially it's a collection of characters that over time have become a competitive edge. So you can start a theme park, build everything that Disney built, all the rides, but you have no Mickey, Minnie, or Avengers, you're not going to attract the same number of people or even a fraction of those people. The competitive advantage here comes from images. Is that permanent? That you will continue to do this? Do brand names fade sometimes? Absolutely. In fact, Disney came awfully close to that happening about 15, 20 years ago. We'll talk about it. Or 40 years ago. 1980s, it looked like the brand name was fading. Walt Disney had been, had passed away. There was a decade after his, and nobody could figure out where to go next. It's not permanent, but for the moment, it looks like they're earning more than the cost of capital. And I do that for all of my companies. And all of them earn more than their cost of capital, except for Bookscape. But the only reason it earns less is because of that total cost of capital penalty. Remember, the owner's not diversified. I used a total beta. 4 of my 5 companies earn more than the cost of capital. And you're saying, of course they're going to earn more than their cost of capital. They're big publicly traded companies. Do most big publicly traded companies earn more than their cost of capital, you think? I mean, after all, they should be the cream of the crop, right? They rise to the top. They get publicly listed. What do you think? Kind of an empirical statement. Start of every year, one of the most depressing things I do is I compute the return on capital for every publicly traded company. That's not the depressing part. That's pretty mechanical. But I've got to clean up for things. So counting returns, you got to clean up for the fact that the accountants don't do the right things when it comes to leases and R&D. And sometimes they get in the way of you trying to compute numbers by writing off their mistakes. Do you see why writing off your mistakes makes your return on capital misleading? Because you write off your mistake, invested capital goes down. And the year after, I don't even know you wrote it off. And you look like you're a great company because you earn more than your cost of capital. So I do this exercise of cleaning up. I compute return on capital for every company. 48,000 publicly traded companies. I get the return on capital for each company. I compute the cost of capital for every company. Again, it's pretty mechanical. Risk-free, I do everything in dollar terms to keep it apples to apples. So the risk-free rate is the T-bond rate. I used a bottom-up beta for every company, an equity risk premium reflecting where they're incorporated and operate. So I have a return on capital and cost of capital for each of the 48,000 companies. And I do a very simple comparison. Did you earn more than your cost of capital? Remember, I'm 4 for 4, right? If you look across all companies, that is the most depressing statistic I look at every year. Take a look globally. 47,700 firms, 27% earned a return on capital that was greater than the cost of capital. That's a very kind way of saying 73% of companies earned less than their cost of capital. Some will have good excuses, right? Or good reasons. They could be young companies, they still haven't built up to earning returns. Could be commodity companies and commodity prices did badly. But about 40% of these companies have earned less than their cost of capital every year for the last 10 years. What does that tell me? You're in a bad business. What's your first reaction when a company's in a bad business? Why don't they just stop, right? Liquidate themselves. The only problem is you're not going to get your capital back. If you're in a bad business and everybody knows you're in a bad business, you try to sell the business, you're not going to get your capital back. You're kind of stuck. But the one thing you can tell them is if you're in a bad business, how much should they try to grow? Why are you even thinking about growth? You should be shrinking. I've never understood airlines that try to grow. What's wrong with you guys? One of the worst businesses in the world to be in. You expand, you're expanding in a bad business. What's the end game here? So when you look at your company and you get your company's return on capital, don't be surprised if the return on capital is less than the cost of capital. Look for reasons. Maybe there's a good reason other than it being a bad business and a bad company. But if you can't find any reasons, your conclusion might be, my company has slipped into a bad business. It started as a good business 30, 40, 50 years ago, but it's no longer a good business. So if you get a chance, go back and a few weeks ago, I wrote a post on the 10 worst businesses in the world to be in, right? Businesses like telecom become a bad business, right? Airlines, automobiles. Banking is increasingly slid into the bad business column. It used to be a good business 20 years ago. Things change, and sometimes good businesses become bad businesses. Any questions on return capital? So if you hear a banker use the word ROIC, there's no magic here. It's return on invested capital. It comes with flaws. It's a nice number to know, but I'm not going to build an entire story on a single accounting number until I've checked it out and made sure that the number reflects where the company is right now. So that's the accounting return on capital theme park. Let's return to the Rio Disney theme park. Remember the measure of a good measure of investment return is based on cash flows. Those cash flows should be incremental and they should be time weighted. Did the accounting return on capital meet any of those standards? First, was it based on cash flows? Accounting return on capital? No, it's based on earnings. So already. Did it reflect incremental? No, I threw everything in there, right? Allocated costs. Is it time weighted? I just took a simple average. It is the worst conceivable way you can measure returns. So you say, why do we spend time doing it? Because half of all investment decisions around the world are still based on accounting returns, return on equity, return on invested capital. So it's a flawed measure. You can see why people use it. It's an accounting measure. And if you come from an accounting background, you very quickly gravitate towards it. So I'd like to fix it. So here's what I'm going to do. I'm going to take those accounting earnings you saw for the project, first convert them into cash flows. It's going to be a very mechanical exercise. Then make them incremental cash flows, and then time weight those incremental cash flows. So let's start with the first step. Incidentally, when you get a chance and you catch up on your project after you've done the cost of capital, the return on capital is like a 5-minute job. You can compute it for last year. See if you're like one of my 4 companies earning more than the cost of capital or less. But don't again be surprised if you find your company earning less than the cost of capital. It happens sometimes for transitory reasons. You're going to become better, or sometimes just because you're in a bad business. So here's the first step. I'm going to take the accounting earnings on this project and make it into cash flows. To make earnings go from earnings to cash flow, 3 adjustments, and I talked about this in the last session. First, you add back depreciation and amortization. Why? Because they're non-cash expenses. They lowered your earnings. You add them back. Second, I'm going to subtract out capital expenditures. So now you see a big number popping up. The $1 billion, the $1.5 billion, the $5 billion that I'm investing over the first 3 years now shows up as a cash outflow. And finally, I bring in the change in working capital. Remember again, what change in working capital does, it makes accrual earnings into cash earnings. So there are my cash flows, and you can compare my earnings to my cash flows. And you notice first that the numbers are more negative up front. That's the initial investment now showing up in my cash flows. But over time, the cash flows start to get higher than the earnings. So it's what you're essentially doing is you're restoring balance to this project by bringing in everything involved and reflecting when the cash flows happen. So I want to focus in on those 3 adjustments and talk about what effect they have on project analysis. So let's start with depreciation. Seems like we're wasting time, right? Because to get to earnings, I subtracted our depreciation, and now we're adding it back again. So you're saying, why even waste your time on depreciation? In fact, there are bankers who use EBITDA as their starting point sort of operating income, saying, why subtract our DA and then add back DA? Is there a reason we go through that step even though it looks like more work? What is the effect of depreciation that requires you to do what we did, subtract it out to get to earnings and then add it back? What effect does depreciation have? Tanmay? It affects your taxes. It reduces your taxes paid. Depreciation matters because it saves you taxes. And how much does it save? It's actually very simple. Take the depreciation amount, multiply by a tax rate. That is the tax benefit you get from depreciation. So in this case, I took the depreciation numbers each year. I multiplied it by the 36.1% tax rate. I get the tax savings from depreciation. That's why we do what we do with depreciation. It's because it saves you taxes. Which leads you to a couple of propositions. One, the higher your tax rate, the more you're going to benefit from depreciation. So if your tax rate is 40% and mine is 20%, you will get a bigger tax benefit from depreciation than I will. You see how this is going to open the door to a certain kind of business, right? Let's suppose I'm in a very capital intensive business. I have to buy aircraft. My tax rate is 20%. Your tax rate is 40%, right? So if I buy the aircraft and I depreciate them, I get a 20% tax benefit. Is there a way you can see an opening for a business here? What could you conceive? As a 40% tax rate individual, Shai, how would you exploit the fact that your tax rate is higher than mine to get a bigger tax benefit? You don't need the aircraft, obviously. I need the aircraft. But could you buy the aircraft and lease it to me? By doing it, what do you gain? You get the benefits of depreciation. You will share some of those benefits with me. The leasing business in the 60s and 70s was born from the fact that individual tax rates were much higher than corporate tax rates, and you could exploit that difference. Like one reason the leasing business suffered in the 80s as those tax rates converged, you took away a big reason for leasing. So the first is a higher tax rate, the greater the tax benefit from depreciation. Which leads me to my second proposition, which is if you're a nonprofit, what the heck are you even doing depreciating stuff? Who cares? I've seen nonprofits hire accountants to depreciate stuff, and no, I don't care. It doesn't make a difference. And there are some non-cash charges that are not tax deductible. There's some amortization. In which case, I'll say just ignore them. Then you're going to reduce them, then add them back. There's no effect. The reason we care about depreciation is because it affects your taxes. So when you depreciate things, you're going to get a tax benefit that increases your value to the project. In fact, a lot of green projects, so-called green projects, a big chunk of the value comes from tax benefits you get from tax credits and expensing and depreciation, not from the actual selling of energy from that project. It's, I think, the weakest link in green energy is how dependent it's become on the tax code and what that tax code does in terms of providing benefits on that project. Any questions on depreciation? Yes. Oh, you had a question, or you're just stretching? Okay. Now, when you depreciate things, of course, you're spreading an item out, right? Once in a while, though, you will get a choice between being able to expense something or depreciate it over time. In fact, if you're a small business, I think up to 50,000 in capital equipment, you can actually expense rather than depreciate. Saying, why would I want to do that? Let's see what the effect is, okay? So when you look at depreciation, you can actually have two types of depreciation. One is straight line depreciation, where you take the amount you've spent and write it off in equal amounts every year. Nice, mathematically, easy to work with. Or you have all these different depreciation methods where you can get more of the depreciation earlier rather than later. It's called accelerated depreciation. Lots of different sub-approaches. So I want you to first think in terms of what effect this will have on the earnings for your project, and then think about the effect on the cash flows. So let's say that I have to pick between straight line and accelerated, but I care about earnings. I want to report higher earnings on my project. Which one would I go with, Derek? Accelerated depreciation will give me higher earnings. Remember, depreciation is an expense, right? So if I write off more in depreciation, it'll actually give me lower earnings up front, higher later. But in terms of cash flows, accelerated depreciation will give me more tax benefits right now. You see your tone between reporting better earnings and better cash flows? You know that most US companies have two sets of books. It's completely legal. There's tax books, which they use to compute their taxes, where they use one type of depreciation, and reporting books, which you and I see, where they use a second type of depreciation. Guess which one they use in the tax books? The most accelerated depreciation you can get because you want to get the biggest tax benefits. Whereas in the reporting books, and where it shows up is in this deferred tax item, something that they have to do to show. So it's visible if you look for it, but it's completely legal. And you can see the game. They want to report higher earnings and have the higher cash flows. They're getting to eat their cake and have it too. It gets even more of an issue when you think about the capital expenditure. Because remember, depreciation comes from capital expenditures. Capital expenditures are cash outflows. We factor them in. But I wanted to think about two types of capital expenditures. One is maintenance CapEx. So let's go back to the theme park. Maintenance CapEx is replacing one ride with a new ride. So basically, whatever the Dumbo ride with some other ride. Why? Because you got to get so it's maintenance CapEx because you're not expanding the theme park. You're just replacing equipment that's expensive that'll give you benefits over many years. Growth CapEx is building an entire add-on to this. So when California Adventure was built at Disneyland, that was a growth CapEx. It was a theme park across from the old theme park. Why did Disney build it? Because it wanted more people to come to the theme park. You think, who cares? They're both negative cash flows. You're right. They're both negative cash flows. But depending on your ambitions for the project, you might have more of one than the other. They both drain cash flows, and because they drain cash flows, you have to bring them in. The one thing you have to do when you do project estimates, you have to be internally consistent. You see what I mean by internally consistent? You tell me that the number of people coming to the theme park are going to increase by 15% a year. I'll go along with it. But what do I need to see as growth CapEx if you do that? You got to be building more additions to your theme park because you can't have people coming in, overcrowding the theme park and have no place to go. So what you assume about growth CapEx has to be consistent with what you assume about how long your project will last and what you think will happen to the project. It's your assumptions essentially being consistent with your numbers. And here again, I'm going to give you a choice. They said many small businesses, you're given this choice between expensing something or capitalizing and depreciating it. And again, I'm going to ask you the question in terms of what will that do to my earnings and how will it affect my cash flows? So let's say that you're a streaming company. You're competing against Disney and Netflix, and you spend, let's assume $100 million acquiring customers, and your accountant says, look, you can expense $100 million right away. You can spread it out over time. First, from an earnings perspective, would you rather expense something or capitalize and depreciate it? Tolu? Capitalize and depreciate it because spreading things out gives you higher earnings for the early years. But from a cash flow perspective, you'd always choose to expense it. Again, you can see two sets of books, right? If I'm given two choices, I'm going to expense everything in my tax books and claim the tax benefit right away. But in my reporting books, I am going to depreciate, amortize, spread over time because it again allows me to have higher earnings in my reporting books and higher cash flows. In the case, I've tried to kind of be clear about what the capital expenditures are. So if you come to a fork in the road where you have a choice, and remember, you don't always have the choice. The tax code lays out what you can expense. You're going to expense things if you can pull that off, but most of the time you're constrained by what the law allows. The tax law allows you to expense some things, but the rest have to be capitalized and spread out over time. And finally, working capital. In the abstract, working capital is just a line item, right? Inventory, receivables. But if you get a chance, walk down Bleecker, check out the retail stores, wait a week, walk down Bleecker again. There'll be 3 new stores where the old stores were. I have seen that street, the turnover in stores is just incredible. Part of the reason is the lease cost is really high. But part of the reason I think in many small businesses is when people assess whether to start the business, they think in terms of what they make in terms of earnings and what they invest and say, that looks like a pretty good investment. But if you walk in any of those stores and you look around, you see a lot of inventory and not much foot traffic. You have inventory and not much foot traffic, you have a problem. Why? Because while that stuff is hanging or sitting on the shelves or hanging on the racks, it's not making you any money. The reason you have to bring working capital into your assessment is you can be earnings rich and cash poor. You see what I mean by earnings rich? You basically report the earnings, but you're not collecting. So if if you're selling on credit, you basically have receivables. If you have inventory sitting around, you haven't recorded it. You're earnings rich and cash poor, and unfortunately, when the bank comes calling, it's cash that you need to pay them. So you can go bankrupt even though your books look really good. So the reason we bring the working capital in to begin with is to capture that effect. So anytime I increase my working capital, that drains my cash flows. Anytime I decrease my working capital, now do you see why marketing and finance is often going to be at loggerheads? Marketing wants you to carry the most styles you can and the most choice because customers like it. You go into a shoe store, you ask for a size. You want the person to go to the back and come back with that shoe size, right? So the marketing person says carry every style in every size, which makes sense. But the problem is that's going to increase your inventory needs. And you might say, look, I'll take the top 20 most popular models. I'll carry it in every size, but I'm not going to carry every size in models where I sell only 5 shoes a year. That's a working capital effect. And that's a healthy discussion to have because you can't just carry everything from the perspective of this will make my customers happy if you can't survive as a business. In my view, a lot of project analyses, the failure comes from not even having a working capital line item because you don't think of it as an expense, right? You think of your traditional accounting expenses. You don't think of the cash flow effect of how much inventory do I have to carry. Until Walmart came along, the rule in retailing used to be that your current assets had to be twice your current liabilities. That's every account and the accounting textbook says the current ratio should be 2. Healthy companies have current ratios of 2. If you think about a retailer and I maintain a current ratio of 2, that's a huge drain on my cash flows. So Walmart came along and said, why does it have to be 2? Why can't I make my current assets roughly equal to my current liabilities? And they went to work on it, right? They created much more updated inventory systems. They were among the first companies that scanned inventory and essentially made sure that you didn't have, 15 of some item you were not selling. They also squeeze their suppliers, not the most, think about it. Squeeze their suppliers in what sense? You're selling to Walmart. Walmart is 60% of your sales as a small producer. They said, we'll pay you in 60 days. And they got the cash right away. So they're using the float. They basically made their working capital into a neutral item. They didn't make it into a, but if you make working capital into a neutral item, and you're a company the size of Walmart, that's $3 billion in additional cash flows every year. This is a small item for some businesses, but it can be a huge one for others. So when you look at working capital, and you can find ways to reduce your working capital, always think about the trade-off. Because by itself, you're saying, why didn't I make my working capital 0? Because you might lose customer sales when they come and say, you don't have my size. So it's a trade-off that you got to work with to see if you can get that right balance between having just enough inventory to meet your customer needs and not so much that you're drowning under your own inventory requirements. So when you look at depreciation, CapEx, and working capital, don't think of them as line items. Put some flesh on them. Think about what they do to your project, your investment, whatever you've decided to put your money in. Any questions on working capital? Okay. Can you actually have negative working capital for a project? I gave you a door, right? In the case of Walmart, what do? They squeezed their suppliers and they insisted on being paid right away. You can build a project where actually working capital becomes a source of capital for you to expand the project. It's not a very good way to do this because if you scale up, eventually it's going to catch up with you. But if you can pull it off, you can see a way in which you can extract cash flows from working capital. So we've gone from earnings to cash flows. Any question on that adjustment? So add depreciation and non-cash charges, subtract CapEx, subtract change in working capital. Now I want to go to incremental cash flow. There are two items I want to mop up on. The first was, if you remember when I gave you the original description of the project, and I told you it cost $5 billion to build the Magic Kingdom and Epcot, I also mentioned that $500 million of that $5 billion had already been spent. And I also said you're not going to get the $500 million back if you decide not to take the project. This is something that in finance we tend to gloss over. We have a rule, but it's actually one of the toughest things as human beings to do is ignore what's already happened when you make a decision. It's called the sunk cost. And if you watch Giancarlo Stanton and you say, what the heck were you thinking giving him a 10-year contract, you're seeing a sunk cost payout, right? Which is the person who created the cost is still running the team, Brian Cashman. And the minute you admit to that mistake, it's, so we'll talk about sunk costs and why we have so much trouble in decision making on it. Okay? The second thing I told you was about that G&A. Remember I said when I allocated the G&A, that 2/3 of that G&A was going to be there no matter what. That's not an incremental cost. So here's the question you're asking when you think about what's incremental. What will happen if I take the project? What will happen if I don't take the project? The answer is the same to both those questions. That item is not incremental. Let's take the sunk cost. You've spent $500 million, right? What will happen if you take the project? You've spent the $500 million. What will happen if you don't take the project? You've spent the $500 million. What difference does this project make? Absolutely nothing. That allocated G&A, the 2/3, has nothing to do with the project. What will happen if you take the project? It'll get allocated to this project. What will happen if you don't take the project? It's going to get allocated somewhere else. It's not like the company is going to save that money by not taking the project. So to adjust for the sunk cost, the easy one was the $500 million that I just took it off the initial investment. So I said, look, $2.5 billion is the total cost, but $500 million of that is sunk. I shouldn't be counting it when I make my decisions. And as far as the allocated G&A, I added back the 2/3 that was not directly related to this project. There's a little tax effect that I have to go to clean up for because I claimed a tax reduction. So I've cleaned up for both of the non-incremental items. What you see here now is my incremental cash flow. We're slowly moving towards our good measure of return, an incremental cash flow time-weighted return. We've gone from earnings to cash flows to incremental cash flows. Now I'll give you a very simple illustration of that, of an incremental cost. Until about 10 years ago, I used to do the training programs for every investment bank. They all used to be in August. And I'd go bank to bank to bank. And after the fifth bank, I had no idea which bank I was in. It was 2-day, 3-day programs. So, and they used to, many of them used to have their training programs in one of the hotels uptown, like the Hilton, because they have big rooms. And they used to hire like 400 analysts in the room. So this was towards the end of an August. I was tired. They were tired, and I give the talk. And there's almost no interaction in the room because we're both ready to get out of there. But there's this person who was catering, who was setting up the tables outside. He was the most, he followed the session more intently than anybody in the room, including me. At the end of the first day, he comes to me and says, "I have a question for you. I've been listening all day." And I said, "Okay, what's your question?" He said, "I'm from Guatemala, and every year I fly back home to visit my family. It costs me about $1,000. And every year I buy seconds. Seconds are clothes in the Gap, which have damage in them. That I buy seconds at these big stores, and I take them with me to sell in Guatemala. I make about $500 from selling." And he said, "All my accounting friends are telling me I should stop doing this." You see how the accounting mindset works, right? It costs you $1,000 to go to Guatemala. You make only $500 selling these clothes. What's the net bottom line? Minus 500. They tell me I should stop doing it, but I have a feeling that they're not right. And I said, "You should stop having accounting friends." Because what is the missing ingredient here? What's a question that they needed to ask him before they said, "You should stop doing it"? Are you going to fly back anyways? And he said, "Of course, my family's there." In which case,
That minus 1,000 is not an incremental cost. It's a cost that's going to be might as well reduce it to minus 500. You're better off. But that's the end game here, is rather than let something that's going to always be there stop you from making a decision, at least you make it less painful. So let's focus in on this notion of incremental cash flows. The way I got to my incremental cash flows was kind of indirect. I did earnings first, and then I had to clean up. And it's often messy doing that. So you can do this on your project. For instance, on the Celsius Eats project, you can do the earnings and then adjust for cash flows. But I'd strongly recommend that you test it out with a second way, because that way you can make sure you got it right. Focus on just the incremental items. So don't do the entire G&A, do only the portion of the G&A that's direct. Ignore the sunk cost. So effectively, I'm going to end up with the same answer. The numbers are going to be the same, but I didn't have all that cleaning up to do because I didn't have to have an intermediate stop in earnings. So incremental cash flow effects basically focus on incremental revenues, incremental expenses, incremental G&A, and you come up with incremental earnings and incremental cash flows. But let's take a pause and talk about sunk costs. Every corporate finance textbook you open up, the advice is simple: ignore sunk costs. I'm going to give you a weekly exercise this week that's going to be extremely painful for some of you to do. I'm going to talk about the cost of your MBA and then the expected potential benefits of your MBA. And I'm going to ask you to compute a net present value of your decision. How many tuitions have they collected from you already? 2, right? Usually they collect right up front, right? They don't let you stay till the end of the semester and then pay. So half your tuition has been paid already. So it should be based on incremental cash flows, right? But the truth is, you think about what you've already, it's tough to leave that behind. Psychologically, leaving sunk costs behind. I mean, imagine standing in line for concert tickets. You gave yourself 30 minutes during lunch for the concert tickets. An hour later, you're still standing in line. You know you should leave right away, but what does your mind tell you? You've already spent an hour doing this. That's now going to be wasted. It's psychological, but it does affect our decisions. So when you think about sunk costs, it's easy to create the rule, but it's ignored in practice all the time. In fact, there was an experiment that was run about 20 or 25 years ago. It's called the Concord experiment. Basically, there were 2 groups of people. You know, they were both given the facts on a new investment, a new aircraft the company was going to make. The first one was told about the new aircraft, and then they were told, but there's a competitor who's actually come up with a much better aircraft than we have, even though we've spent time. Would you do it? And they said, no, of course we should, because they were given the earnings and cash flows. The second group were given exactly the same information, but were also told, we've spent $5 billion building this aircraft. Should we do it? And many of them chose to do it because they'd already spent $5 billion. Classic example of how sunk costs skew our decision making. So it's something that psychologists, so this is part of behavioral finance that we've discovered, is it's very difficult for people to leave sunk costs behind. My advice when you have to present a project analysis, especially if it's a project where the incremental effects, don't talk about what you've already spent and how much time you spent. It's almost guaranteed to lead to bad decision making because those sunk costs are going to skew the decision. So sunk costs, we know what to do, but at the same time, it's very difficult to do it. So here's a simple example of how costs become sunk. You're a consumer product company. You've spent $100 million on test marketing. Remember, McDonald's does that, they have a little barbecue thing that they come up with and then take it off the menu. Let's say you spend $100 million in the test marketing. And looking forward at what's coming, you think the project will create 25 million based on expected future cash flows. You've already spent 100. So what does every finance textbook tell you? Well, ignore the sunk cost, take the project. It's better to make the 25 million and make the loss 75 million instead of 100 million. Financially, that is actually the right thing to do. But if every single project this happens,
You know what I mean by this happening? You spend 100 million first, and then it's a sunk cost, and then you make 25 million. How long will you last as a business? Not very long. This is the story of R&D at many pharma companies, right? R&D, by the time it's spent, it's become a sunk cost. By the time you get to the decision of whether you should do something, the $3 billion you spent developing the drug has become a sunk cost. Well, but early on, pharmaceutical companies, when they had pricing power, complete pricing power, would say, not a problem, we'll just price it in. But if you start to lose pricing power and you continue to let R&D spend money first, you're sunk as a pharmaceutical company. So you're saying, what choice do we have? You actually have to have a first level assessment before you spend the R&D, given the uncertainty in the process, and say, should we even be investing in R&D? Because once you spend the money, it's way too late to try to get that money back. So we know what to do with sunk costs. And if you look at this, you should take the investment, but you clearly have to think if this is the pattern that you're going to follow. In fact, this morning, it would have been pure coincidence. I get an email from somebody who works at a company, is computing the IRR for a project. And he said, when I compute the IRR for a project, which IRR is basically a time-weighted incremental cash flow return based on the future, he said, should I include sunk costs? He didn't use a word. He called it pre-project investments. And I gave him, my answer was no and yes. No, if you're using it for your decision making, right? Because your decision should be based on what's coming. And yes, because you need to keep track of the economics of your projects internally as a company, because this keeps happening, you're in a bad business. You might want to stop that spending 100 million up front before you make that choice. But I think we need to keep track of both things, which is on an incremental basis, we need to ignore sunk costs. But as a business, we need to think about the economics of our projects, and that requires thinking about what we spend up front as well, even though it's sunk. Okay. Any questions on sunk costs? So think about all the sunk costs in your lifetime, because we all make personal choices that become sunk costs, and think of how it affects our decisions. Because then you're going to see this play out on a much bigger scale in businesses with hundreds of millions or even billions of dollars. Which brings us to allocated costs. It told you allocated G&A is this gigantic expense item looking for something to attach it to. It's in every large firm. It's a big chunk of what gets attached to a project. Even at smaller firms, you see the show. To the degree that your project creates additional G&A costs, of course you should factor them in. They're incremental. But if it's only an allocated cost and it's going to go somewhere else, counting it in is going to lead you to reject investments for all the wrong reasons. So when we add back that allocated G&A, that's what we're trying to do. So one of the questions you often face is in the problem, in the case, I gave you what that incremental G&A was. You're saying, but in the real world, how would I know how much G&A is incremental and how much is fixed? I'll give you a very simple example, and maybe you can work out an extension of this for a company. It's not for the Celsius case, but in general for any company. Let's suppose that I gave you the revenues and the G&A costs for a company. Year 1, year 2, year 3. Okay? Is there a way that you can tease out from the data how much of the G&A cost in year 3? Take the 300 million year 3. How much of the G&A cost is fixed and how much is variable? Leon, you want to help me out here? So what's the definition of a variable cost? That should move with revenues, right? So if you look at my pattern, I've kept the numbers kind of easy to work with. When my revenues go up by 200 million, my G&A went up by 20 million, went up by 300 million. So it looks like for every $100 million in revenues, I get an additional 10 million in G&A, right? One way to think about how much is fixed is make your revenues go to zero. It'll be a catastrophic event for your company. But if you make your revenues go to zero, what will happen to my G&A? 10 million for every 100 million revenue. So I go from 1,500 to zero. My G&A will drop by 150 million. It doesn't drop to zero. There's still 150 million left over. That's exactly how hotel companies felt in 2020. Their revenues dropped to zero because of COVID. You had nobody traveling. But their costs did not go to zero because a big chunk of their costs were fixed costs. Airbnb, in contrast, the revenues went towards zero. The G&A costs also went towards zero because almost all of it was connected to the revenues. It's not a perfect measure. There are lots of noise in it. But if you take a company's history of revenues and G&A costs, you can start to eke out from it how much is fixed and how much is variable. So in this case, 150 million is fixed G&A, another 150 million is variable G&A. And that's good to know when you think about how much should I be attaching to my project, because that fixed G&A is what kills you when you start to allocate the project, because it's going to be there no matter what you do. We've gone from earnings to cash flows to incremental cash flows. Let's talk about time weighting. Time weighting is just the time value of money, right? It's just discounting. And in a sense, we've already laid the foundations for what discount rate we should be using. These cash flows are cash flows from a Disney Rio theme park, and we've already concluded that the cost of capital for the theme park is 8.46%. We have our discount rate, we have our cash flows. I'm almost ready to discount those cash flows every year when I remember that 10-year problem that I had. At the end of year 10, when I got my return on capital, I said, I wish I could go longer, but it's so much work. Is there a way I can stop in year 10 and then bring in what happens after year 10 without explicitly going year 11, year 12, year 13, if I'm working with incremental cash flows? Constantine, what can I do? Sorry? I'm going to come up with an estimate of how much this project is worth at the end of year 10 based on an assumption, a kind of general assumption of what happens after year 10. I mean, in valuing companies, we call this the terminal value, but basically it's a continuing value for the theme park. Now, you're saying for how long? Well, I could go an extra 15 years, an extra 20 years, an extra 30, an extra 50, but here's the advantage. Once you get past years 30, 40, 50, you might as well go forever. What's the advantage of going forever? Well, you can actually get the present value of the cash flows forever much more easily than getting the present value of cash flows in an extra 15 years. Mathematically, it's easier to work with. I know most of you don't work with time value equations, but I don't believe that present value function in Excel. Even after using it 30 years, I'd never use it. I prefer to build in my present value equations, and it's not rocket science. There are only 5 kinds of cash flows you will ever run into in finance. It covers the spectrum. You can have a single cash flow in the future. What would that be like? Well, if I told you that you have a $40 million payment coming due in 30 years, what's the value of it today? That's a single cash flow. You can have an annuity. What's an annuity? A constant cash flow every year for a period of time. So you're Juan Soda, and I say, I'll pay you $70 million every year for the next 10 years. That's an annuity. There's the equation for a present value of an annuity. That's the payment button N in a standard calculator or in Excel, the present value of an annuity. You can have a growing annuity, which almost never is built into a calculator, but it's actually a nice equation to have. What's a growing annuity? I have a gold mine. It creates $1 million in cash flows. I expect to grow 3% a year for the next 25 years, and then there's no more gold left in the mine. And they say, how much is this gold mine worth? There are 2 ways I can compute the present value. I can do the cash flows in the next 25 years, discount every cash flow back, or in one equation, I can get the present value of those cash flows. If you don't believe me, take it and work it out with the numbers. It's a growing annuity. And then the last 2 are kind of mind-boggling. They're cash flows that last forever. You can have a perpetuity, which is a single cash flow every year forever. The British and the Canadians used to have, they're probably still around, bonds called console bonds. Console bonds, you got a coupon every year in perpetuity. Reflects the optimism of those age that forever, they've stopped doing it, right? But you got a fixed cash, that's a perpetuity. Or even more mind-blowing concept, which is a growing perpetuity. Growing perpetuity, you got a cash flow growing at a constant rate forever. This is the most misused equation in finance. But what does it allow you to do? It allows you to take a cash flow growing at 2% a year forever and come up with the present value with one equation. Everything in finance is some combination of the equations. What are the 2 cash flows that go into a traditional bond? What do you get every year? You get a coupon, which is an annuity. At the end of the lifetime, you get a face value, which is a single cash flow. You want to value a stock? Well, if you assume the cash flows will last forever, if it's a high growth company, you'll have cash flows of the high growth period. Could be a growing annuity. And then you get to year 5 or 10, you say, well, it's only going, the growth rate is now low enough to be forever. A growing annuity plus a growing perpetuity. Take any security out there and you can break it out into its cash flows, and you have the present value components to come up with the value. So here's what I'm going to do. I'm going to get to year 10 on my theme park. I'm going to stop estimating cash flows, but after year 10, I'm going to bring what happens after year 10 into the value that I assign to this theme park at the end of year 10. And I'm going to use 2 decision rules, both of which use time-weighted cash flows, but may be useful in different contexts. The first is called the net present value. What is the net present value? I take each cash flow, discount it back to today, add up the present values, and I come up with the sum of those numbers. Nice thing about NPV is it's greater than 0, you accept the project. If it's less than 0, you reject the project. And that sometimes, seems like, difficult to get through. Let's say you have a project where you spend $1 billion, and I tell you the net present value is $10. What's your reaction going to be? That's not enough. I spent $1 billion. How do you explain to somebody that we have an investment that costs you billions, and even having a $10 million or a $10,000 NPV is still okay? How do you explain that? Chris, what do you think? How do you get through to somebody, big investment up front, you come up with this really small NPV, that it's still okay?
Zero is a losing option.
It's a little more than that, right? NPV is over and above your cost of capital. So I'm not making, I'm making the 8.5% cost of capital plus an extra $10. Would I rather make another 10 billion? Absolutely. But remember the table I showed you, 73% of the world struggles to earn 0 net present value. You earn $10, you're already in the winning side of that equation. So small net present values, as long as they're positive, are over and above the cost of capital. I'm going to take it. But the problem with NPV, it's a dollar number. We don't think in dollar terms. We try. Tanmay, what did your portfolio make last year? You don't have to give away too much. You can make up a number if you want. The answer I got was a percentage return, right? Ask anybody what they did, the return is. Because we tend to think in percentage terms. NPV is nobody, if you ask them on a portfolio, says, my portfolio made 16,385 in net present value. They just give you a percentage return. And IRR is a percentage time-weighted return. What do? You take those cash flows and the initial investment, you solve for a discount rate that makes your net present value 0. The old days, it was trial and error. You tried 8, then you tried 12, then 9, and 11. Now, of course, you hit the IRR button, it gives you an answer. It's that discount rate that makes your net present value 0. A lot of people who use IRR, and I'll give you the survey statistics on IRR versus NPV. You know what the reasoning for using IRR is? We don't have to come up with a discount rate. And it's true, right? Technically, to compute the IRR, you don't need a discount rate, whereas for NPV, you do. But the problem is, once you get the internal rate of return to make a decision, guess what you need? You need a hurdle rate. You need a discount rate. You can't run away from that. The question is, where do you bring it in? So I'm going to use both approaches for Disney. But I'm going to put in closure on this project by assuming that after year 10, the theme park will keep going. For how long? Forever. No, this sounds incredibly optimistic. At Disneyland 500 years from now. I'll talk about why I'm okay with the forever. But I'm going to add some constraints. I'm going to assume that after year 10, the number of people coming into the theme park levels off. And that the increase in cash flows will be roughly equal to the inflation rate. What am I effectively assuming? That the ticket prices will go up by the inflation rate. Why am I putting in that constraint that the number of tourists are going to level off in year 10? If I did not do that, France, what would I have to do on this theme park? If I say the number of tourists are going to grow by 2% a year forever, what's going to happen to this theme park? You can have as many fast passes as you want, but the theme park is going to be so crowded that people are going to come in through the front gate and not be able to move, right? If I have to grow the number of people coming. It's a perfectly appropriate assumption, but then I have to come up with an additional theme park or an expansion. I don't want to do that. I want to keep the theme park as is, keep the number of tourists leveled off, but the cash flows will grow at the inflation rate forever. I have a growing perpetuity. I'm going to compute the present value of that growing perpetuity by taking the cash flows in year 11. You always have to do that present value equations, go an extra year. So there's my cash flow in year 10, growing at 2%. And divided by my cost of capital, and already you can see why I needed that discount rate first to do this, minus the growth rate, I come up with this incredibly large number, 11,275 million. I'm going to go put that in to year 10. And that tilts the scale. Remember, the project did not look good on an accounting return basis. Now, when I compute the net present value of the cash flows using that 8.46% cost of capital, the NPV that I get is 3.3 billion. I actually did this for a group at Disney 20 years ago. There were two levels of pushback. One is they said, but even Disney theme parks don't last forever. And that's absolutely true. Nothing lasts forever. So why am I using a perpetuity? Because once you get to 50 or 60 years, the value that you get is roughly equal to the perpetuity value. And we said Disneyland is already, 68 years. So I think that the project life is long enough that you can get away with it. If you have a pain in the neck in the group who says, I want to be precise, maybe you have an actuary in the group. Once you're 65 years, concede it. Doing a growing annuity, you get roughly the same answer as doing a perpetuity, but we do it for convenience. The second pushback was a little more subtle. This is the number that tilts the scale, right? 11,275 million. We know mathematically where it came from, taking the cash flow in here, but what exactly is that 11,275 million? Intuitively, give me a way of explaining what that number captures. Patrick, you want to try? What's 11,275 million? I know, but no, what does it mean? Somebody who's not in finance, so we can use terminal value, we all might get it. But let's say it's somebody who's a theme park guy. Yeah. The value of the theme park to somebody else with everything in it, right? Including Mickey, Minnie, which means Disney will never sell the theme park, because you can imagine Disney selling a theme park with the characters in it. It's a hypothetical. It's what you think the theme park would be worth to somebody else if you sold it lock, stock, barrel, and Mickey included. When you do terminal value, that's the way to think about the terminal value. It's what somebody will pay you based on the cash flows on this theme park in perpetuity. And we're tying up that loose end. So the project is a good project. The net present value is 3.3 billion. And here's the nice thing about NPVs. The minute Disney takes this theme park, its value as a company increases by 3.3 billion. NPVs are additive. Every time you take a positive net present value project, your value goes up. Every time you take a negative net present value project, your value goes down. You know, there are companies out there that take projects with NPVs of minus 5 billion. No, Microsoft took one with a net PV of minus 10 billion. And Satya Nadella is a great CEO. What are these projects that can have NPVs of minus 5 billion, minus 10 billion? I mean, how can a project get that big? I mean, it's got to be an immense project, right? To lose that much. Remember when I talked about projects, I described all kinds of projects, internal investments. I talked about acquisitions. Talked about strategic investments. Talked about inventory reinvestment. Which of those do you think has the highest chance of being a minus $5 billion project? How much did Microsoft pay for Activision? About 50 billion. The day they did the acquisition, Microsoft lost 10 billion in market cap. Why? Because investors looked and say, we don't see the upside here. We don't see the benefit. You paid this premium over the market price. We don't see the synergies you're talking about here. Okay? When you do a big bad acquisition, it's essentially the equivalent of taking a negative net present value project. The next time you see a news story about an acquisition, don't look at the target firm. Nothing interesting is happening there other than the stock price going up. Look at the acquiring firm, because that's where you're going to see that judgment that investors are passing on, whether this is a zero net present value project, a positive or a negative one. And I think I mentioned this towards the start of the class. 55% of acquisitions, the acquiring company's stock price goes down on the announcement. At least investors are passing judgment on this is a negative net present value investment. So NPV has this great feature of being additive. You can take a company and actually write it as a sum of the present values of all of the NPVs of the investments it's taken. But as I said, NPV is a dollar value. Let's talk about IRR. I know the way we compute IRR is we hit that IRR button on Excel, or we get a number. Not only do I not quite trust the number, I think we lose a lot of information when we do this. So instead of doing that IRR calculation by computing that number from an Excel spreadsheet or a calculator, I'm going to do what's called an NPV profile. Sounds fancy, but I take the cash flows, I keep them the same, and I change my discount rate. Usually when you raise the discount rate, the net present value is going to go down. You're saying, why isn't that always? We'll talk about cases where there might not. In most projects, raising the discount rate in NPV, so I compute the NPV at 1%, 2%, 3%, 4%, 5% discount rates. What am I looking for? Where the NPV is zero, where it crosses the line. That's my internal rate of return. My IRR for this project is 12.6%. Is that a good IRR? What do I compare that to? To my cost of capital, which is 8.4%. So basically, it's a project with, is that always going to be the case if you have a company with a positive NPV? Its IRR is going to be greater than the cost of capital. Most of the time. We'll talk about exceptions to the rule, but they're exceptions. Most of the time, the two rules will converge because they share a great deal, right? They're both time-weighted. They're both incremental cash flow returns. Think, what do you gain by doing this? Notice the slope of that line. In fixed income foundations, you probably talked about duration. What is duration of a bond measure? Sounds like a dumb question, but what does it measure? Anybody? I'm glad because usually people, when you ask them duration, give me time and say duration measures when the cash flows come due, which is true, but it's also a measure of how sensitive your bond price is to changes in interest rates. When you have a high duration bond and interest rates go up, your bond price will drop by more. In fact, it's a slope of that line. So if you graphed bond price against interest rates, it's a slope of that line. So high duration bonds are in a sense riskier than low duration bonds. Do you see the analogy here? What does this graph measure? It measures how sensitive your NPV is to your discount rate. So let's say you have two projects that you're trying to pick between a Rio Disney project and another project that has exactly the same NPV. But that project has a much flatter line. In other words, it's much less sensitive to discount rates. This project, because it's more sensitive, would be riskier to you as a company, because if the cost of capital changes, you're far more likely to see pain when you have a So that's the additional information you get from an NPV profile that you will not get by just computing an IRR for a project. So this project's IRR is 12.6%. It's higher than the cost of capital. And for the most part, the two will move together, especially if you have a standalone independent project like you do here. If you have to pick between projects, you have to rank them, things get a little messier. But I think we spend way too long talking about NPV versus IRR, when in fact, once you've adopted one or the other, we're closer than using an accounting return on capital or some other measure of picking projects. They're both time-weighted. They're both incremental cash flow based. They both pass the test of being good measures of returns. And in this case, they're both pushing in the same direction, which is this is a good project. Just go out and take it. Okay. Any questions on the path? So basically, take a look at earnings to cash flows, because you will be doing this on your Celsius Eats project, right?
You'll compute, you'll have to come up with the earnings because I do ask you for return on capital. I ask you for cash flows and incremental cash flows. I leave the decision to you, so you can use whatever decision rule you want. But ultimately, this is your money. You work at Celsius. This is the company's money, the shareholders' money being invested in the snack food business. And you have to think about, does it create value or not? When I started my number crunching for you, I told you I was going to cheat and do everything in US dollars. Cheating because the project is in Rio, the cash flows are going to be in reais, right? I should be doing this everything in reais. So without even looking at the numbers, I want you to think about what would happen to the NPV of this project if I did everything in reais. So my cash flows are going to be in reais. My discount rate is going to be in reais. So let's start with the discount rate. When I go from a dollar cost to capital to real cost to capital, what will happen to my discount rate? Carolina? I'm sorry. Your name's Carolina? No, okay, sorry. Now, what's your name? Amy. Amy, sorry. Yeah. So when you think about doing everything in reais, I go from a dollar discount rate to a real discount rate. How would I get from dollars? Would the discount rate be higher or lower? And I go from dollars to reais. You can call a friend, right? It's like we can make it, Patrick, you can help wherever you want. So I go from dollars to reais, will my discount rate go up or go down? Okay, now, you want to try? Yeah?
I would say that the de-riskiness of the cash flows would go up. So
No, wait, it's the same project, right? So all I'm changing is the currency. The cash flow risk is not changing. It's still in Rio. So none of that is changing. All I'm changing is the currency. Shai? Anybody want to try? Okay. It'll go up, but tell me why it's going to go up. It's not the risk going up because it's the same project. The risk is the same. Why do currencies matter? Stability, but also what's the missing ingredient? Yeah, inflation, right? The real is a higher inflation currency. It's going to go up because inflation is higher in reais. I'm going to get a much higher cost of capital. In fact, I'll show you how much higher. It's going to be 15.91% instead of 8 point. That's terrible, right? Higher discount rate. It's because the inflation rate in Brazil is 9%. The inflation rate in the US is 2%. That's the only reason. It's not country risk. So when you switch from currency to currency, it's not like you're looking at a different project, the same project. So my discount rate is going to be 15.91%. Let's go to the cash flows, right? My cash flows were in dollars. Now I have to convert them to reais. So convert dollar cash flows to real cash flows. What do I need? The same inflation rates, right? So instead of having a 2% inflation rate behind me, I have a 9% inflation rate. I'm going to get much higher cash flows in reais because my growth rate is going to be higher. It shows up through my exchange rate. There's this very simple proposition that drives exchange rate. It's called purchasing power parity. What does that mean? If you have one currency with a 9% inflation rate, the other with a 2% inflation rate, the exchange rate over time on the higher inflation rate currency, it'll weaken, the higher inflation rate. So if you look at my starting point, 2.35 reais per share, by the time I get to year 10, I'm getting 4.56 reais, entirely driven by exactly the same inflation differential that drove my discount rate. Already you can see where I'm going to end up. I have a much higher discount rate, 15.91%. I have much higher cash flows in reais because I have that same extra 7% helping me out each year. When I compute the net present value that I end up with is 7.75 billion reais converted into dollars. I get exactly the same answer to the nth decimal point as doing everything in US dollars. It's almost magical. But why is it happening?
because I'm making sure that when I raise my discount rate for inflation, I'm also adjusting my cash flows for exactly the same inflation. This is incredibly good news if you think about it, because it means you can pick your favorite currency to work with and work with it on any project anywhere in the world if you stay consistent. What gets us into trouble is being sloppy. Having one currency play out in your discount rate, one currency play out in your cash flows, the net effect can be all over the place if you're not careful. So in this case, I did everything in dollars, but I could have done everything in reais, and I've got exactly the NPV, and that should intuitively be the right answer, right? A project shouldn't be good in dollars and bad in reais, or good in, switching currencies. That's like saying, I can change the temperature by going from Fahrenheit to Celsius. You don't. It just feels a little cooler if you do things in Celsius because the number is lower. But it's not changing. Currency should not change the fundamental characteristics of a project, because the riskiness, the cash flows, the margins are all there. It's just an inflation effect. So I will end with that. And Wednesday, when we start, we're going to talk about uncertainty, and then we're going to talk about all these side effects. So again, read the case if you haven't already, because it can help you in thinking through the
Yeah. Go ahead. So what do you have to